Hey, it's Soleil, and this is episode 147 of the Orange Pill Investor. And today I want to talk about which is a better leaps play. I'm going to look at MicroStrategy at first, but then I'm going to take a look at maybe something cheaper as well. So I got wrecked back when I had I think I had the 1400 strikes on MicroStrategy, and it ripped to like 17 something. So I ended up paying like 35 grand to roll that position because I didn't want to lose all of my shares. At one point, I think I did sell some of them. But to prevent that in the future, I went ahead and bought some leaps, and I bought the 3800 strikes right here. So bought the 3800 strikes for November, and it was basically I didn't really do all of this research that I'm going to show today at the time, but it was basically the cheapest things I could afford. And so I had nabbed like 3 of them for 5 grand a piece, and it was right all the way at the top of the options chain. So the 3800 strikes were the cheapest I could afford. And for leaps, I prefer to go out, I mean, hell, I think these were 180 days when I bought them, a little bit more maybe. But I would love to go out a year, really. I never hold leaps under 60 days, and I really start getting anxiety around 90. Theta really starts to pick up speed, and the value of your option really starts to decay. So I'm losing extrinsic value every time that happens. Now, if MicroStrategy was to rip to 10 grand or something, and now this thing is not out of the money, it's in the money, then maybe that time value really wouldn't even matter at that point. But right now, since this is out of the money, all of this value is extrinsic. So this is all time value. This has no inherent value to it whatsoever, which is intrinsic value. So let's just say you were made of money, and this, I grabbed this $5,000 leaps, 3 of them, because it was the cheapest that I could get and still be out like 180 days and not really have to worry about selling this thing for like 3 months. So, but let's just say you were made out of money, and you could choose any option in the entire chain that you wanted. What would affect your decision making of, should I get one expensive option like an 800 strike, or approximately 6 of the cheaper ones, which would be about the same price. I couldn't get it exact. Actually, I tried to put a decimal in here because you'd need 6.77 contracts but the results are going to be so obvious that it's really not even going to matter. So approximately spending 83 grand on 6 contracts at the 3800 strike where I bought, versus buying just one at the 800 strike and paying 94 grand. So you put in MicroStrategy, get price, select the option that you want, and then I put the ranges. I tried to put from 1200 to 5000, and it just changed it automatically at 1143. I don't know what calculations it's doing. I like output and profit loss dollars. I think the default is like percent or something. Anyway, I like this one. And so then I just hit calculate. So buying this 800 strike is going to cost me $94,000 now. And if the price, let's just do some short-term stuff. So by June 7th, if the price were to rip up to 2 grand, 2032, I could make almost 34,000. So it would be worth 128 grand, paid 94. You can get 33.98 out of that. With the same investment, let's go to the 2032 strike. So this would be buying 6 of the 3,800 strike calls. Click on that one. It's worth 146 grand minus the 83 that you paid for it. Looks like the returns are about double. Yep, 34 grand versus 62 grand. And actually you're investing even less than the 94, about 10%. You're using 10% less collateral here, but I could get twice as much return on the same rip to $2,000. Now my covered call strikes are at like 17 something, close to 1,800. So I would still get wrecked, but for like 10, 20 grand on a 2K rip. And these are just built in to mitigate that that wreckage somewhat. But let's just go clear to the top of the chart. If you buy the single big option for 94,000 and the price rips to 5 grand for 4,953, now the option is going to be worth 416,953 minus the 94 that you paid for it. You could make $322,000. But buying 6 of the cheap leaps, you can make $1 million. Now, this is just all hypothetical bullshit, but it's just illustrating the point about maximum collateral efficiency. And even if you're not an option seller like myself, if you're just an option buyer and you think MicroStrategy is going to be obscenely valued in the future, like end of 2025, can I even slide this over? I want this to let me slide over past October. Oh, here we go. Boop. Yeah, if you think at the end of 2025, I'm sorry, this doesn't even go to 25. Sorry, I bought this option in November of this year. So, belay my last. All right, so if you thought MicroStrategy was going to be like 5K by November, which I'm not saying it is. I'm thinking I had end of 2025 in my head because that's when I would probably be looking to trim some of my MicroStrategy position, just in case Bitcoin continues to do its 4-year cycles. Bitcoin breaks all the models, and so this could just be a fake out. It's like, okay, it could just be like, okay, it looks like I have these 4-year cycles, but I'm going to trick you into believing it after 3 or 4 cycles go by, and then I'm just not going to do it anymore. So I don't make any kind of predictions. However, if Bitcoin is 150K, 225, something like that towards the end of 2025, I will be looking to trim, not necessarily some Bitcoin positions, maybe, but I will definitely be looking to trim some MicroStrategy positions because it's leveraged Bitcoin. So I saw a really good Kelly Criterion video by Krueger, and if you follow Kelly Criterion, it was recommending a 52% Bitcoin allocation, 48% cash, and then when the price of Bitcoin rockets up to 150 or 225, you're constantly rebalancing to that 52% Bitcoin allocation, which means you're just every month or two or whatever, you would be selling off some Bitcoin. And I know Sailor says never sell your Bitcoin. This is just all hypothetical. So you'd be constantly maintaining a 52% Bitcoin to cash ratio. And then you'd have a bunch of cash probably by the end of 2025 if the cycle holds. And then during the bear market, you would be reallocating all the way back down and you'd be buying the dips with that cash. And then at some point, the dip would bottom out and then you'd do it all over again. So I will probably be doing something similar to that with MicroStrategy, regardless of whether I actually trim any of my Bitcoin holdings. Considering that I sold half my Bitcoin to buy MicroStrategy a couple of months ago, I may not want to pare my my Bitcoin holdings down unless it does something super crazy. And even if it did, I would still be looking to pare my MicroStrategy position down, because if it's going to be leveraged off of Bitcoin's price, then it would make more sense to take profits in MicroStrategy than it would Bitcoin. So I could have said all of that with fewer words if I only had more time, but let's just say by November of this year, correct myself, it's not next year, but by November of 2024, if the price of MicroStrategy was $5,000, let me start with the 800 strike call. That's kind of like my baseline. So at 49.53, at expiration, if you just decided to forego all of your extrinsic value, you don't give a shit, and you can actually technically exercise on this date, but that's, I don't know if I'm going to have time to talk about that today. Generally, exercising is a bad idea unless you're very close to expiration, or if the liquidity is just so bad that you can't get a fill and profit off the extrinsic value. In that case, it would make sense to exercise. But of course, to exercise this option, you got to have the $800 times 100. So you'd have to have the 80 grand to make that happen anyway. Which, if you're already buying, options that cost 94, you probably can handle it. So maybe that's not an issue. But so anyway, you could collect $300,000 off of this single option that paid, you paid $94,000 for it. So you could, triple your money, a little over triple. Good work if you can get it. But at expiration, the 6 contracts would be worth $691,000 minus the 80 grand that you paid for it, and you'd profit $600,000. So about double the profit. So that seems to be pretty consistent. Is that the 3,800 strikes, buying as many as you can. If MicroStrategy does something amazing, buying multiple of the cheaper top of the options chain with tiny deltas and a smaller price is more cost efficient than a deep in the money option that's very expensive but has a high delta. The delta on this was probably like 0.9 or something ridiculous. All right, so I was pretty sure that this would be the case just with a little bit of experience and kind of eyeballing these, that this would be the case, but I hadn't actually done this side-by-side comparison. And so let's just take a look at something like HUT, and it's so cheap, I just went out to January 2025. Actually, let's go out all the way. Let's go all the way to January 2026 and potentially just hold through the whole entire hypothetical Bitcoin cycle. And the thing about options is generally you buy options to sell them. You don't really buy them to exercise them. Like I said, you're foregoing all of the extrinsic value if you do that. And you would probably want to target some kind of strike. Like if HUT gets to 20 or 25 or 30, kind of ahead of schedule, like where do I feel comfortable taking some profits in here? But this is all the way at the top of the chain. This is January 2026. It's a $35 call. It's the cheapest one that you can get. And if I don't really assign a multiple for these miners like I would MicroStrategy, like if Bitcoin goes up, doubles, then MicroStrategy will probably go up triple or quadruple or something. They're a leveraged Bitcoin play. But the miners are, you know, if Bitcoin doubles, maybe the miner doubles. If Bitcoin triples, maybe the miners triple. So if a double on Bitcoin from here would get us to 150 and a triple would get us to 225, then that means HUT might go to 20 or 30, or like 18 or 27. Let's just do 20 or 30. So buying this bad boy for $1.50, that's the mid price. Let's just say a year from now, June, the price would have to be 17 just to break even. And that's why you need these moves you need sharp moves upward. And when you get a chance to sell way over here in the green, you kind of have to take it, because if the price goes up to 20 for, you know, in a couple of weeks, and you're like, oh wow, I just made $500 off 152. You're like, oh, but maybe it'll go up more, and then the price doesn't, and it doesn't, and it doesn't, and it doesn't, and it doesn't, and you hold that all the way to expiration, and now instead of making $500, you lost $150, which is your entire purchase price. So anytime you can get this dark green, for me, that's a sell indicator. This means that I won, and if I sell it for $327 at the 17 and it goes to 20, okay. Just like buying shares, you can't always catch the top. But if it does go to 30, even if it goes to 30, you're still gonna lose $152 if you hold it till expiration, if it only goes to 30. Now, anywhere in here, you know, if it did it by, you know, in 2 weeks, you could make $1,000. But then, of course, by next June, if it's at 30, you can make $600. So 4 extra money. So the principle is still the same. And yeah. I'm not as bullish about the miners as I am MicroStrategy, of course, but you take what you can get, and until the ETFs have options and I can really compare something else, this is an option as well of just buying, and I sell covered calls in HUT. So if I sold $150 worth of premium on covered calls, that would probably take about, what, 7, 8, 9, 10 contracts or something. But if I made $150, then I could buy one of these leaps. And then next week, if it took me 5 weeks to collect $150 or 10 weeks, then I could buy another one and another one and another one. And then if you get some giant up move and the price, you know, just clears your strikes, and you don't get to capitalize on that upside because you limited your upside, then it's possible this could be an insurance policy against that. Now the weird thing, and this is the last thing I'm going to say before I jump, the weird thing is that Quant Bros, I think it was Ryan, he posted that the call put skew is insane right now. And so let's take a look at the options, and I'm going to go out only about 44 days. So the current price is $1,700. So let's go $300 above and below the price and compare. Generally, those amounts should be about the same. So let's go to $2,000 and see how much we could sell a call for. Damn it. Could sell a covered call for $141, $300 above the strike price. Let's go 300 below the strike price and go to 1,400. I forgot to put. $1,400 in order to buy a put is only $86. So it's skewed in favor of the seller for right now. Selling the calls the calls are expensive and the puts are cheaper. And I'm so bullish on MicroStrategy, I kind of can't imagine a situation where I would buy puts on it and basically shorting the stock. But in a weird, perverted kind of way, buy low, sell high, there's some weird argument that could be made to sell calls and buy puts. You're selling the calls because they're expensive and you want to sell things that are expensive, and you buy the puts because they're cheap and you want to buy things that are cheap. But I gotta imagine the only explanation for this is that the market makers are so terrified of this going up that they're making the calls expensive, and they're not really that worried about MicroStrategy going down. That maybe is less of a risk. So I don't really know how the algorithm figures out what the price shit, but it was definitely a head scratcher when Ryan pointed out this call put skew. I don't even know that's exactly what you call it. But along the lines of what I've been talking about here, for upside protection, I was saying, okay, I bought these 3,800 strike calls as upside insurance, but if I'm selling covered calls and I want more downside protection, then it seems like I would want to go out here. Let's just go out like not quite a year, but let's do, actually let's go over a year. Let's do December 19th, 2025 and see what this is going to cost me. And instead of going all the way to the top of the chain, I'm going to go all the way to the bottom of the chain. And 100, the liquidity is going to suck ass down here. So there's, it's actually not as bad as I thought. It's about $1 in the bid-ask spread here. So 33 people are bidding 350. You get 2 askers at 440. So you could probably get filled around in here somewhere. But I'm selling covered calls on a $1,700 stock and getting about $1,700 a week, and I could pick up 1 or 2 of these every so often. Once a month, just pick up one of these, especially if MicroStrategy rips to 2K. That probably would have been a perfect time to buy puts last time, because when it ripped to 2K last time, it dropped, within a couple of weeks, it had dropped down to 1,200 again. So this probably would have worked out. So I don't know if I'm going to get the guts to pull the trigger on something like this. I would probably do it after MicroStrategy pumps, like this $1,700 isn't quite juicy enough for me. I want to see a nice, I want to see this. I want to see it rip from 600 to 15 or 18 or 2. So maybe this would have been a good time to do it when it ripped from to 17 again. I might have been able to make it a little more. I don't know. Yeah, I want to see something huge like this where you're going to expect it to retrace some of those profits. You know, from 500. I feel like when something rips like this, it usually loses 50 to 75% of the amount that it went up. So let's just say if we say from here, so from 700 to 2 grand, that's 1,400. So if it lost 50% of the 1,400, that would be down 700, which is about what happened here. So if you count this as the rip, that's 1,500, and it went down 700. Oh, actually, it went down 1,000. So yeah, 50 to 75% ish. When these giant spikes happen, it usually from the peak down, it kind of retraces a good bit of that, and then of course we're picking up speed again. So it'll be interesting to see if this tripled. Is the next rip going to be to 4,500? That's going to be insane. So can't wait to see Bitcoin go to the moon and drag MicroStrategy along with it. Maybe it's kind of like the moon affecting the tides. Maybe Bitcoin is the moon and MicroStrategy is the tide. Which, if this shit happens again and MicroStrategy goes to 5K or 10K by next year, it won't just be the tide going in and out. It'll be a freaking tidal wave. So I think that's a good place to leave it. All right, be good, y'all.